and thanks for joining us for another quarterly update on the Airlie Australian Share Fund. Today we're joined by Portfolio Manager Emma Fisher and also Joe Wright. And exciting news, Emma, we're joined by Joe for the first time as a Deputy Portfolio Manager.
Yes, very exciting. Avid fans of the Airlie quarterly videos, which I'm pretty sure is just my mum, would recognise Joe from past videos, and I'm pretty sure every time I introduce him I mention what a star he is. So this role is really just formalising that. You know, I've become very reliant and really respect his opinions and his work. So very excited to have him on board.
Congratulations, Joe.
Thanks, guys. Thanks for the introduction. Yeah, I've been working with Emma for 3 years now. I think we work really well together. And prior to this role, I spent 4 years at Schroders in their Australian equities team. And yeah, I think we'll just continue to work well together and deliver our performance for clients, which is the North Star of Airlie.
Great, thanks, Joe. Well, it's been a wild 3 months, Emma, in markets. We've seen US rate cuts finally come through. We've seen some stimulus with China, and we've seen markets move all over the place with reporting season. Can you talk through how the fund has navigated this last quarter?
Yeah, I think wild is the right word actually for markets, but you know, it's been a good quarter as well. The ASX 200 has returned just under 8%. The Airlie Australian Share Fund has returned pretty much flat with that, which to be honest, I think is a good result. You know, I would have thought we'd really struggle to keep up with a market that strong, particularly given the size of our underweight to the big four banks, which again this quarter had another cracking quarter of performance. You know, to contextualise, I suppose, the size of our underweight there, we own CBA and NAB, but we have been selling both of those stocks as they have, you know, gone on to extraordinary valuations. If you allocate $1 to passive, you know, to the Australian index today, you're giving about 22 cents in the dollar to the big four banks, and $1 allocated to our fund is about 8 cents. So we are as underweight the big four banks as we've ever been, which has cost us this quarter, but we are comfortable with that position purely because we think the valuations have gotten so extreme. You know, if you take Westpac, for example, Westpac in 2011 was making an ROE, so a return on equity or a measure of its profitability. It was making an ROE of 19%, and you were paying about 10 times earnings for it. And if you roll forward to today, ROE has absolutely collapsed. It's now making a return on equity of about 9%, and you're paying 17 times earnings for it. So, you know, to us, the 40 to 50% rally that the banks have seen over the last 12 months has been predominantly driven by the PE, not earnings, not the dividend, but the PE. And in our minds, that's quite unsustainable and a bit of a one-off driver that could just as easily go the other way. And in fact, for many of the major banks, potentially with the exception of CBA at the quality end of the spectrum, we think it should go the other way. We think they are considerably overvalued. And
thinking about stocks outside the banking sector, stocks that have been volatile in the quarter, Mineral Resources looks like it's had a bit of a volatile period.
Yes, that is the understatement of the century, Virgo. I think that MinRes basically started the quarter at share price of $53 and ended the quarter at a share price of $52. So if you'd fallen asleep through the quarter, you would have thought, you know, nothing much happened. But what actually happened was probably the most rapid implosion and then explosion of a share price that I've ever seen in such a short period of time, certainly for a company that we've invested in. So in terms of what actually happened, it all sort of started with the result in August. It was a poor result, and the most disappointing part of it was a capex blowout at their Onslow project that came at just the wrong time. You know, it came at a time where the balance sheet already looked really stretched before they had the cash flows from that project kicking in, and at a time where the two major commodities that they're exposed to, iron ore and lithium, you know, the prices of those commodities were falling and were really in the doldrums. So on the day of the result, we reduced our position slightly to reflect, you know, the increased risk of that poor balance sheet. The share price would have been in the mid-40s at the time, and then very, very quickly it fell, you know, day after day after day. It bottomed out at about $29, and then in the last 2 weeks of September, as China fired up stimulus, which, you know, Joe can go into the reasons behind that in a second, it went the other way. You know, it bottomed out at 29 and then it had this extraordinary rally over the next 2 weeks. You know, I think it was up over 70% in the end. So where it stands for us in terms of position sizing, you know, given that increased risk around the balance sheet, we do have a smaller position in it than we've had versus our history. You know, at one point we were 5% active this business many years ago, and today we're about 2% active. So we think that really balances the risks hopefully correctly, and it does remain a core portfolio holding for us. Yeah, and then maybe Joe, if you could sort of give a bit more colour around what happened on the resources side.
Yeah, no problem. So you go back to the start of the September quarter, and sentiment was getting increasingly bearish towards commodities and the metals and mining companies in general. You had the chairman of Baowu Steel come out and talk about a long, harsh winter for Chinese steel makers. You had macro data out of China increasingly disappoint. Iron ore price came down to sort of $90 a tonne from well over 100. And it's safe to say, the stocks sold off alongside, that sort of information. And then, as Emma talked about, you had sort of two key events, I think, that really changed sentiment in the market towards a lot of those commodity stocks. Firstly, you had the integrated battery maker CATL come out and adjust production at their lepidolite mine and refineries, basically, confirming to the market or the lithium sector that they were going to behave rationally, amidst a period of weak prices. And then you had, more importantly, China announced quite a material amount of monetary and fiscal stimulus, and that basically put a rocket under all commodities, iron ore, met coal, base metals, precious metals, with the view that China was going to see a significant increase in demand as a function of that stimulus. For our portfolio, we benefited through overweight positions in BHP, Min, IGO, BlueScope as well increased with the view that China was not going to have to export as much steel as they perhaps had previously been doing, and even Seven Group again through their Westtrac business, saw the share price go up because maybe there's a view that production in the commodity space in Australia is likely to be pretty stable.
You touched on BlueScope. It's a relatively new position for Airlie. How does that stack up in the Airlie process?
Yeah. BlueScope's the company I've written about in our insights before. It's a business that stacks up really well under our process. Balance sheet, it's net cash. There's surplus property. There's a lot of optionality in the whole portfolio. In terms of business quality, you have great returning assets, a vertically integrated steel building products business in Australia, and a steelmaking business in North America that's bottom of the cost curve. And you have a really well-tenured management that has a great track record of capital allocation. And then lastly, from a valuation perspective, we think it's on 10 times PE, mid-cycle, and offering about a 5% yield in the form of dividends and buybacks.
Thanks. Just finally on commodities, the only commodity that seems to have been unable to catch a bid is oil. Can we maybe talk about that a bit further?
Yeah, that's right, Joe. Oil is the only commodity that hasn't really caught a bid on the Chinese stimulus news. There's a view in the market that perhaps Saudi Arabia is going to be less disciplined on production, which has perhaps capped oil prices in the medium term. In the fund, we have an overweight position in Santos, but we're actually underweight the oil and gas sector. But I will say, as those share prices have fallen, we're redoing the work on the space because more broadly, we do think the fundamentals for energy look pretty good. We also have a position in Ampol where actually a lower oil price should, perhaps result in margin expansion for their refining and retail businesses.
Great, thanks, Joe. Em, if I turn to you, just thinking about the next quarter, the next year, next 5 years, I can't not ask you about how the stocks and the things that you're most excited about.
Yeah, there's a few stocks in the portfolio that I am really excited about. I mean, the first one, I feel like I'm kind of always talking about this stock, but ResMed, I think it's a standout. It's probably worth talking about still, even though it's, had an enormous year. When we put it through our process, it still looks so attractive. It's going to be net cash this year. It's got a long-term track record of generating return on invested capital well over 25%. Great management team, and it's trading on 26 times earnings, which is really only a smidgen more than the average industrial business on about 23 times earnings. So, they had their investor day this week, and they've articulated for the next 5 years that they intend to grow the top line high single digit and the bottom line ahead of that. So you could think of that as 5 years of double-digit earnings growth, and certainly if they deliver that, we think it very much deserves to be a large position in the fund. So that's one that we really like. The second one, it's a little bit down less exciting end of the spectrum, but the valuation I think makes it very exciting, is Medibank. So Australia's largest private health insurer. Again, putting it through our process, it is net cash, return on invested capital in the 30s, great solid management team that I think have done a really good job navigating that business through COVID. And the stance that they took was, we're not going to profit from COVID. We're not going to profit from the fact that hospital visitation has fallen away. And so instead, they've paid all of that back to their members. And if you're an AHM or a Medibank member, as I am, you get these great cashbacks back to you each year. So that's really set them up quite differently from their competitors that haven't done that. They've just sort of let it go to boost their gross profit. And so we think the business is in great shape. The opportunity right now, the stock's very cheap. It's on 16 times earnings. It's really derated. And the opportunity right now is because everyone's very worried about the regulatory risk. Now, I don't want to downplay this because there is regulatory risk, but we believe that's what's creating the opportunity. It feels like every day that you open the paper, there's another article about private hospitals and what stress they're under. And basically, the private hospital system is arguing that the pendulum has sort of swung too far towards the insurers in terms of their profitability, and that they're not sharing enough of that pie with the hospitals, and they're asking the government to intervene. Now, for a number of reasons, we, I suppose, are positioning ourselves that this, a very close version to the status quo is likely to prevail here. And that really comes down to the fact that, the government really cares about keeping claims inflation very low. They're very sensitive to premium increases during a cost of living crisis. Every time I get a bill for my car insurance or my home insurance, has gone up double digits, whereas my health insurance is going up 3% per annum. So it's really been the bright spot in a cost of living crisis, and I don't think the government want to change that. And anything that sort of rejigs the pie really aggressively back towards the hospitals is going to lead to higher premium increases, which is what they don't want. And they're particularly sensitive about that going into an election. So I think that's what's creating the opportunity to own this great, very resilient business. And, bringing it back to that absolutely rock solid balance sheet, I think you can the business, the investment, you can sort of afford to take on that opportunity, knowing that even if we're wrong and there is some regulatory rejig, the balance sheet means that this business is going to sort of thrive no matter what.
Thanks, Emma. Thanks, Joe. Congratulations again as Deputy Portfolio Manager. And thanks for joining us today. As always, if you'd like to share this with colleagues or friends, please do so. Thanks for joining.